All right. So what I want to cover today is really how I conceptualize the market and what I do to prepare myself for each day, and the kind of tools I use to operate. It's picking my contract or determining when to enter and exit a position. So I guess at a base level, what we're really looking at when we're trying to trade options is a little bit different than what we'd be looking at if we were trying to simply purchase a stock and hold it for a long term. Um, because we, for the most part, are day traders, we don't really swing anything, and we're definitely not taking anything with leaps. So, I mean, there's nothing that we're taking that's really months out, aside from the occasional contract from reality. There's a certain level of granularity that we need to keep in mind. A lot of the times when people are talking about building a set of levels or identifying kind of what you want to look at, they tell you to start with the daily, right? I think that this is a good place to understand the overall trajectory of a stock. If you've been in the market for, the last year or 2 years, you're going to be pretty well aware that over the last year, for the majority of tickers, we're going to be in a relative downtrend. The last 2 days, you're starting to battle that, but we'll get into that later. The larger time frame that you utilize, the less impactful it's going to really be on your day-to-day trading. Now, like, you can go through, like we always decide, it's like, well, what is a level and what is the importance of it and what do I need to watch? Because sometimes you go through and you start to see people's charts and they have 1,000 levels and you really have no idea what's going on. So the main goal is to determine what is really important, to keep your chart as clean as possible. So to start, where's the notebook? What is a level? Everybody has kind of a different definition of this. Some people are a little bit more strict. For me, all a level is a spot where we have a point of interest, right? So these points of interest that we see, it doesn't really matter if we're looking at a rejection, if we're looking at a support. It's a place or a price point, more specifically, that we see continual movement, right? So when we're thinking about levels, some people are like, oh, it's, in this example, 417, like spot on to the dot, to the cent, nowhere around that. I don't think that that's really a good way to look at this. When we're talking about levels, we need to think that this is an area that we can start to observe, right? All we're trying to do is determine a point in the chart where price action has either continually been supported or resisted, right? You can see that in most cases, and using this little range as a good example, the spot isn't necessarily to the dot, right? You go through and you can see that there's multiple touches in an area, but not necessarily the exact same dollar value. Like here, we're looking at a high of 416.46. Here, we're looking at 416.61, right? Just because these 2 points, these just as an example, aren't the exact same price value where they started to reject, doesn't mean that this area isn't something that we want to look at. So the first thing that I try and get across to people is when you're thinking about levels, you need to get rid of the thought of everything having this really strict rigidity, and go into it with the mindset that this is simply a spot, an area, a range, or a little bit of a zone where we want to start looking for something to happen, right? So the easiest way to do that would be to do it mathematically, right? You put all of these numbers into a chart and you're like, oh, well, there's a bunch of price action happening at this dollar value, but we realistically aren't going to be doing that. So when we're going through, all we need to do is we're using our eyes, right? So this in itself kind of creates a little bit of a variance person to person, especially when you're using larger time frames, right? All you're really doing, and this is like a kindergarten example, you're just really connecting the dots. You're taking your cursor, and obviously if you're using TradingView or something else, you're going to do this a little bit differently. And you just start to mark points where you have multiple touches, right? Not an exact science whatsoever, but the point of this is you're trying to figure out where do you see large groups of supports and resistances? Where do you see points that have been resisted on multiple, like you have a pullback and you come back up to it and it's being utilized again, right? All you're trying to do is provide yourself a little bit more granular way to break down the market. Without these levels, we'd have to be looking at each individual minute and kind of compare it to the last. So all we're doing when we're looking at large time frames is just providing an easier reference point, right, to do this. Everybody always struggles with the levels side of things when they're getting into options trading. And I have spent hours trying to go over, oh, well, it's this big mathematical breakdown. It really isn't. Like, you're really just connecting some dots here, right? And all you're doing is trying to see where price action has consistently fallen in multiple places. That's it, right? So there's no real magic behind this. You're just connecting the dots here and there. So where this starts to get useful for me is when we start to look at points that are levels. Oh, get out of here. I hate when it does that. That we haven't retested, right? So as the chart moves forward, you can see that we have all these highs, right? That we haven't come back up to retest. And then the same thing goes for lows, right? We retested all of these over here. But on the way out, kind of an outlier. And here. So what we're doing is we're really looking at levels in two different ways, right? You can go, oh, hey, in the past, we've actually touched an area multiple times, and then we've come back and redone it. But what I find to be the most important are trying to figure out these areas where you're likely to see liquidity breaks or breakouts, which are the highs and lows that you have not come over to retest. In doing that, come on, it gets to a certain zoom where I can't see anything. And all you really need to do for that, right, is find high points, literal high points where you're bouncing up, extend them out. And if you haven't come back up to retest them, if it's a high, or come back down to retest it if it's a low, then it'd be a valid point that I would start to look at. So rather than just drawing a line across, oh, well, we see a lot of stuff going on here, seeing that a high actually falls in there that we haven't touched, this level becomes more important, right? This is an area that when we got up to it, we immediately rejected, and that started a massive downtrend. This is what I'm looking for when I'm eyeing up the daily chart, right? I'm trying to figure out, well, where are these highs and where are these lows, and what is the gap in between them? Where are we going to target? Where is the next thing that's going to start breaking the structure of the market or continuing the trend? So step one for me, if I was to start from scratch, is just identification of highs in the market and identification of lows in the market that we haven't tested. So basically, if you can draw a line from a high and there's no candles up by it, I think that that's something that I need to keep track of, right? For the daily, that is literally all I use it for. I trade day to day. I rarely swing anything. The daily chart on a whole doesn't really matter to me, right? Our overall trajectory is important. I like to know if we're in if we're in a small uptrend or an overall downtrend. But because I'm trading day to day, hour to hour, I don't really care too much about the overall macro view. Sorry, somebody say something? No. Word. Does this make sense to everybody? All right. So as we start to like carry these levels over, it's good to figure out a good way to organize, or sorry, it's good to organize how you do this. For me, I'm just going to do this on a couple. So on Thinkorswim, we're able to create obviously our price line. But what I do after that is I'll remove the left extension, and then I'll just set the time frame that I'm so you get something like this. So you're able to clean up your chart. I really don't like having levels that go all the way across. I don't think it's necessary. What is up what you're looking at? All right, so that is good. So daily time frame, what am I looking at? Overall market highs and lows, just to get a better understanding of the range that I'm going to be playing between when I'm taking day trades, right? So where I actually start to come up with levels I'm going to use in my trading is the 4 hour. So you don't really need to go back and, you know, an infinite amount of time. Most of the times where we're at, it's going to be between some highs and some lows on your chart, unless you're at the very bottom of something, in which case you might have to move your time frame back. But on the 4 hour, this is where I start to really figure out what my strategy is. So when we're day trading, right, time frame is really important. You have to realize that you need to be able to move between spaces in whatever duration that you're going to be holding contracts, right? So on the 4 hour, I like it because I get 2 candles for each day. And I just find that it's not going to clutter up my chart, and it's super, super easy to create a bit of a trade plan from this. So the same thing that we did on the daily, right? You can see that even on the 4 hour, we're starting to visualize these highs and lows. On the 4 hour, I'm going to start doing the same thing. You can see here, like this would be a high that we're looking at, but because, and this is what I was talking about with revisiting the price action, because we've already come back through and broken it multiple times, this high in particular, it's not really something I care about anymore, right? But in the reverse, these lows, because we haven't touched them on the opposite side, are okay. So you can see this is super easy. When I'm charting, it really doesn't take me all that much time to create a trade plan. So on the 4 hour, I know that we can move in between these areas. This was retested today, but it's also going to be support. Boom. Okay, so that's all we've done. All we've done, right? We've just made it easier for us to see highs and lows of the market, right? These are areas that we've either rejected or bounced off of. Simple as that. Where do we bounce? Where do we reject? Why is this important? Because this is where the market is deciding, oh, I'm not going to pay more than this for the stock, and we come back down. Or the market says, oh, this is a great place to buy, and we start to move back up. As options traders, this is really important for us, right? We need to identify where the market has previously said too much, or, you know, oh, this is cheap, this is a great buy, because these are places where we start to think about entering our contracts. These are places where we look to exit our contracts. Depending on if we're in puts or calls, it can be used either way. But these highs and these lows become the main areas that we watch when we're trying to decide what we're going to do on a day-to-day basis, right? So I use this on the 4 hour. If we start to zoom in a little bit, chart's pretty clean, right? I don't even use, one sec, I don't even use this. EMA is there. I have RSI on here. I really don't use it. For me, this is what my chart looks like on most of my computers. Volume and then my levels, which are going to help me determine my highs and my lows. That's it. That's all I ever really trade with. So when we take this down into a time frame that I am actually going to execute on, right? So I like to use the 15. Let's go back here. Yesterday kind of fucked everything, huh? No, science is see big movement is out of ranges. It does get a little bit more confusing. So I guess we can say, let's start back here. So 15-minute time frame is the time frame I tend to execute on. Why this time frame? I find that the majority of the trades that I hold, I end up holding them for between, on average, 30 minutes to about 2 hours. You're going to have days where that's not always the case, but this time frame just gives me access to enough information versus, you know, trying to read the 1 minute where there's sometimes too much information on the chart. You don't need it. It's good. It's good for granular data if you're trying to determine the volume, but overall 15-minute is good. So after we have our highs and lows drawn on the 4 hour, the daily, we can come back in and we start to do the same thing.
Okay.
Somebody said the same thing on the 15-minute because this is the time frame I tend to execute on. Everybody's different.
And then I would tell them.
Bullshit.
So it's better I tell before.
Yeah, you have to.
You're muted. And we can go back in and do the same thing. So it gets a little bit confusing when we're looking at days like fucking yesterday where we run up 150 points or 130 points. But let's see if we can get something going here just to see how we could have executed on that and how we should have. And then as you start to go through, right, you're going to start to come across areas like this one in particular that we had at 398.2, where points that you bounced off of, right, become points of resistance. The more that you see that, the more important that price area is. You don't see that with every price point, but lately we've kind of been doing that. Okay, give me 2 seconds here. Okay. So I really have a difficult time when I'm trying to break down what we're doing when we're drawing levels, because I always feel like I'm missing something, right? Like the concept of literally just looking at the price action seems almost too easy, right? But all we need to do is we just need to identify where people have decided, hey, this is so cheap, I'm going to buy it, or the opposite. Hey, this is too expensive, we're going to start selling it off and start taking profit here. That's all we're doing as traders, right? So seeing where this has happened historically allows us to create a little bit of a guideline for how we operate. So let's figure this out. This is another one that we can pull out all the way. So going into your day, let's assume that we're going to start in this area, right? We know where our levels are across the board, and we're going to start right here, right? So we wake up in the morning, market's about to open. What do we do, right? Well, it's it's not rocket science, right? Executing on it's a lot harder than conceptualizing what we're going to do. But to simplify the process, all we're doing is we see where we're at in terms of the current market price. We look to the upside, right? Where's the next level that we need to watch? We look to the downside. We see what's the next level we need to watch. And then all you need to do, right? Knowing at this point you're dead center, play out what happens if it goes either way, right? So there's really not that many options at the start of a day, right? So you have a level to the upside. You have a level to the downside. What's your play out? What could happen, right? You could go up, you could reject it. Come on. You could go up and you could break through it. You could go down and you could reject it and bounce back up. You can go down and break through the level, right? So every morning when you wake up, all you need to do is see where you're at and look at where we had historical price action, right? Where we had price action previously, where was a major point that we either had resistance or support to the upside and downside of the current spot that you're at. And you just plan accordingly, right? So people always talk about not having a bias when you go into trading, right? Like, and there's been days, and I've obviously been there yesterday. I kind of got burnt on it, where you're like, oh, well, it's going to be a down day because of this, or it's going to be an up day because of that. You're going to save a lot of headache in the end if you can come to the realization that the market could go any way at any point in time for any reason, right? There's nothing saying that in the middle of the day, some news article can't come out, totally fuck up the current trajectory, totally break the market structure. That, like we saw in the last couple of days, that some sort of economic report comes out, or somebody just speaking.
I'm going to check if what?
Whatever they want. They can totally flip the market direction, right?
Jarvis, hold on. Mate, you need to mute. You need to mute people, man, because there's people talking in the background and your chat's saying mute, and everyone's been writing it on the chat to just mute the entire chat because someone's driving and they're speaking.
I've been muting people. I couldn't hear anybody on my end. One sec.
Yeah, no, we just hear like weird noise.
That was with me. The Scion FRS, the black one.
Yeah, if you could just mute the entire chat.
That was with me.
Yeah. Okay. Sorry, I had my volume down really low. I thought I had muted everybody. Oop. All right. Don't fuck this up. I can't even see where my Zoom chat went. Sorry, that's probably why. Where are you at? Oh, damn. You guys were going off. All right, I'm gonna make sure that this chat is is up. That's my bad. All right. So lots of people need me to mute. So did anybody hear anything? Because my volume is down. I couldn't really hear any background noise. Yeah? Okay, cool. So good to proceed. That's what I like to hear. So after determining these points of interest, right? And like I said at the very start, these aren't necessarily finite numbers. I'm not like if we go and we break over 397.49 and we get up to 397.5, I'm not going to immediately take calls, right? That's not how this works. It's just an area where I start to look for a rejection, or an area where I start to look for a support, right? But at the start of the day, and every day I do this, I wake up and I go, what's the top? What's the bottom? Right? And I map out all the possibilities. At a certain point, you'll just do this in your head and get a pretty good understanding of what you're doing. That's it. So for the most part, we have 4 potential outcomes, right? This is not assuming that we just range, which is the worst possible outcome. But if we get to our price points, we have 4 possible outcomes. So when we're in between these price points, I don't really react, right? I wait for the market to take me where I need to be. So in this case, here or here, and then I react accordingly. Everything in the middle of these price points, especially at the start of the day, I don't even care about, right? Until I get up to that area that I'm watching. Everything in between, in the middle of the day, I just totally fuck off. So at this point in the morning, I create my alerts. Boom, done. So we open basically halfway between 2 points. Or I can zoom out, where we saw previous price action. You know, we had a bounce here, pre-market kind of held below. Now we're 5 minutes to open. We're kind of right in between. So you always run this risk in the morning of assuming that something's going to happen, right? And after about 5 months of slow movement in the market, I started to realize that I don't want to sit here all day. I try and stay away from my computer as much as humanly possible during the trading day. Obviously, I'm checking the chat, but like the last thing that anybody wants to be doing is staring at a chart, you know, when you're ranging in this zone. So when I start to look at where I want the market to go before I react to it, and I kind of plan out what I'm going to do, and we'll get to how to do that after. I just set a couple of alerts, and I don't need to be staring at the chart. The alert triggers when it starts to get close. It's just like an arbitrary distance, you know, as we start to approach this previous price point, or as we start to approach this price point, I get an alert. So I come back to the chart. Make your life easy. Don't stare at the chart for 8 hours a day, every day. You really don't need to do that. I don't think that it makes you a better trader. This saves you a lot of headache, right? So we're here, we're 5 minutes to open. I know where my price points are because I've seen previous price action. So in this case, the day before we had a strong bounce going to close. And then about midday, we sort of held this level, in this instance, 397.5, before breaking back through it and starting the downtrend for the rest of the day. What am I really looking at here, right? So and I wish I had a notepad here. We're at 396.3. Our price target is 397.5 that we're going to look at to the upside, and 395-ish to the downside. Under this, right, the previous, we don't really have anything lower here. This is where it gets a little iffy. Sometimes you need to go way the fuck back. Where is this? Come on. Okay. So we're opening here. So we don't know that we're going to go to the downside yet. So we look at previous areas where we had a bounce level. Yeah, it's going to hold true. So we go back in time, be like, oh, hey, we bounced right around here. We're looking, you know, roughly 393.5, a little bit under that, 393.2. So somewhere in this area, we're going to be looking at that as our price target. Assuming we don't know this, we don't know anything after this day opens, don't know what's going to happen. And then to the upside, we had pre-market, a little bit of a bump. So what do? We're going to try and determine what the distance is between the price points that we're looking at and the price point either above or below that. So we're starting the day here, 396.3. We know that our first area to the upside that we want to watch is 397.45. Above that, the next bump up is 398.2. So if we were to take calls around this area, right, I want to make sure that my options contract for the most part is going to be in the money, or, you know, not incredibly far out of the money by the time I hit my next price point. This is how you're determining your price targets. And this is all I'm doing every day when I'm posting these levels. I'm just going back, looking at our price history and the way that we are reacting in the days previous, right? I don't need to go back a year to find out that I have this level here, right? That's why I think that the daily chart is good, but it's not really necessary for what we do. You just go back and go like, hey, over the last couple of days, last week, it's like, these are the levels that we have. You could draw your chart for operating, you know, off of 3 days of information, maybe a week of information, probably give you a little bit more consistency, make sure you're not missing anything crazy, but you don't need to go back and you don't need to do levels for the daily necessarily. A lot of the times those daily levels are going to show up again somewhere in the last few days or as you approach them. Again, excluding events like when Powell talks, FOMC meetings, CPI, usually we'll bust it up. But I mean, for just normal run of the mill day trading, like these high volatility events are a totally different thing. But for just day-to-day trading, you can just go back a few days, you know, be like, hey, low is here. Low is here. High is here, we haven't touched. High is here, we haven't touched. Low here, we haven't touched yet. And then just your trade. So I know that I even think making calls until I get to 397.5, right? To the upside, I'd probably go and take, a 398 call, maybe 399 call, right? Easy. It's all I'm really utilizing. A lot of people are looking at open interest or volume on contracts. I'm playing SPY, so it doesn't really matter. There's always going to be liquidity there. There's, you know, you're seeing thousands and thousands of contracts move on SPY. It doesn't even really matter what your strike is. So I used to like go compare and be like, oh, well, the open interest to volume ratio is this or that. It's like, I don't really even need to do that anymore. It doesn't really matter. Liquidity is going to be there. So you're going up, you're like, cool, I'm going to take it from here up to here. So 398, maybe 399. I'm not going to go and take, you know, 406 call, 408 call. That doesn't make any sense. Like you have to, when you're taking a contract, it has to be reasonable. You have to actually be able to get there, you know, like the market makers will sell you a contract. It's, let's say that you have something that expires the next day. They'll sell you something way the fuck up at 415. Doesn't make it a good buy because it's cheap. You know, you look at your price points. Well, if I break this, where am I more likely to go? Well, it looks like maybe I'll make it up to 400. So maybe something to 400 would be like the max that you'd want to take here. But like, I'm not trying to send it up to 409. Like in no world would that be a feasible contract. So when you're trading with options, like, especially if you don't have a lot of money, it's everybody's first instinct to go, oh, I'm just going to buy something that's a million points away, right? It's cheap. Cheap doesn't necessarily mean good. A lot of the times when you're buying something that's so far out of the money that there is literally no value and like the likelihood of it going in the money is next to nothing. Yeah. Okay. SPX is a little bit different and we play that a little bit differently. I'll cover that in a second. So you try and pick something that's in the realm of possibility. A lot of the times when we're taking SPX contracts or SPY contracts that seem like way out of the money, as a lot of people would see with some of the lottos I've taken over the last few weeks. It is possible for them to go in the money. It's just super unlikely. So does this make sense? Does this kind of unbiased layout of what I look at in the mornings make sense, right? Like I really do, like, you want to observe what is every possible outcome, right? Makes sense to everybody? Okay. So here's where it's going to get a little bit confusing. So we're going to remove this box. I'm going to remove this. I'm going to draw in color for you. So when we get to these individual price points, just because we're going to the downside doesn't necessarily mean we look to take puts. Just because we're going to the upside doesn't necessarily mean that we're going to take calls, right? So as you saw at both of these points, there were two different arrows. There are two things that you can look to do here, right? So we know the price point, in this instance, it's been a support, right? As well as a resistance. So we could break up or we could reject from here, right? You need to watch as it starts to play out to kind of make that call. But what you can do, and this is what I tend to do, right? So if you take it to the upside, let's just edit this, make this green. Your first thought is to take this really ugly, I'm sorry. Your first thought is to, oh great, I'm gonna take calls, right? But the opposite of that right, is going to be to take puts if we reject. Now, when you're looking at this, and the thing that I've come to really appreciate as a trader is the distance between your price points, like what direction you're moving. So if you know to the upside, you have a price point that's at 398, right? You're maybe a half point, 0.75 away from your entry level, let's say. That's not that much distance, right? That's not necessarily a great play, because you're more likely than not to bounce off of this high, or at least see some resistance as you're moving up. But if you inverse that and you look the distance now between this price level and this one, you actually have significantly more if you were to take puts, if it does reject to the downside, right? So when you're identifying where your levels are, you also want to be looking at, well, what would be the optimal situation, right? I would love to have a point where there's nothing in the direction that it's going, right? This is going to be unhindered all the way down. And you can see that that's kind of what happened here, right? Versus if I go up, I might see resistance right here. I enter here, boom, fucked, right? Immediately. At least here, if I'm entering puts, the likelihood of anything stopping me, because there's no levels that we have in between, is less. So what I do, right? I look and I'm like, great, if we go up here and we reject, what put would I be able to take? Put all the way down here, right? 395-ish works. But to the upside, I have about, like I said, 75 cents of movement. I would love for it to come up and reject, because I have way more space to move, right? The bigger the gap, the more money there is to be made with less, bouncing around. And then the same thing would be true for the upside on this. Right. So if we come down and we hold this as support, I'd love to be able to take calls, because then I could take calls all the way up to here before I have any issue. So this is the benefit of taking the opposite position most of the time to the direction that you're moving, right? Those reversal plays, they're really like, they get a little tricky to catch, because a lot of the times you'll have massive wick throughs, but this is what's going through my head. Oh, fuck these candles. Sorry, it's not a great canvas here. This is what's going through my head as we're moving, right? So I have ideal, I'm just going to do this because it's going to bother me, ideal playouts. But I've covered all my bases, right? So I know I'm sitting here. I know where my price levels are immediately from where my current stock price is. I know the one up on each one of those. So in this case, 398, and wherever this one is, somewhere around here, 393.5, right? You need to know both of them, because you need to look for a spot where you're going to enter, and you need to look for a spot where you're going to exit. So out of these plays, right, if we go down, and even if we drop down here, I could take this to the downside further. There's a lot more room to run to the downside than to the upside. So ideally for me, we come down, right? That's what I'm looking at. If you see a bunch of levels, right? Oh, price point, oh, price point, oh, price point, oh, price point, right? That's when I don't really want to look to enter any calls. That's when I get a little bit hesitant about taking any plays, right? You want to have distance to the downside. There's good distance to the upside. If you start to see, oh, well, there's a high that we haven't tested. Oh, there's a high that we haven't tested. Oh, there's a high that we haven't tested. They're like 10 cents apart. That's when you start to reconsider the trades that you're taking. You want to see good linear moves. You want to see a good space between your price targets, right? If you see something that's like, well, fuck, I have a level here, a level here, a level here. That's just like a big wall, right? You don't want to see that. That means that you need to break through all these spots that we've rejected in the past and haven't been able to break. Like that just, when you say it out loud, doesn't sound good. It's not a high probability setup. Okay, so after we actually take a trade, and in this case, you can see that the play out, we came up after market open, approached this level, right? So the price target that we talked about to the upside, where is it? Upside price target, boom, rejected it, or at least came close to it. This is what I'm saying. It's, we don't need to touch it to the dot. You know, see the price, the levels here that we were rejecting, we came close to it. We approached and we sold down, right? You're not always going to touch it to the dot. Sometimes you're going to go over it. Sometimes you're going to go over it or under it. The main thing is that you're just watching how close you're getting. Are you approaching a level that we've experienced some sort of, you know, reversal, some sort of bounce? The area around it, the closer you get to it, the more likely you are to see a move in the opposite direction or a breakout or a random impulse play. It doesn't always need to be right at the level. Make sure you know that. If you take anything away from here, levels are not finite. They're not always finite. Levels are just an area to pay attention. So in this case, we came up, came back down, broke through, right? Where there's way more movement to the downside. We actually hit 1, 2, 3 price targets, right? Move completed, hit it from the upside, rejected, broke through the next price target, which was a floor from the day before, came down to wherever this one ends up being, over here, boom, done, move done. Every time you start to get to one of these where you're expecting or anticipating there to be some sort of support or resistance, you raise your stop loss, you start to trim out right before you get there, because you know there's going to be some fuckery there, right? You know you're going to get some sort of bounce, you know you're going to get some sort of pullback. Like 9 times out of 10, it's going to happen. So if you're really oversized, you want to make sure that as you're coming towards it, you start to take profit off the table. If you wait and you're like, oh, well, good, I hit it. Sometimes you'll just get that immediate, like, boom, bounce back. And then you go from like 60% and then you're back down to like 30%. You're like, fuck, I should have trimmed. That's how you determine where you're going to trim. That is what you're watching for, right? These points, where were the previous lows? Where were the previous highs? That's all you really need to be watching. Now it gets a little bit more involved, but from a base level, if you knew nothing about options, that's it. That's all I'm watching. Does anybody have any questions about that? Does this make sense? This is like it seems really simple, but it's like you're creating a web of possibilities, right? Anybody? Are you asking me what a reversal liquidity grab is? Okay. Just before you, somebody asked me the difference between a market order versus a trailing stop. Market's going to sell you out at whatever price they want to give you, right? They don't really care if you hit sell market. You could be like way under the bid. They're never going to give you more money. They're always going to try and give you as little as possible, versus a trailing stop, which literally just, if you're down 15% from any point, it's going to sell you out. So it's really a limit sell. So it is just going to sell it at that 15% down, but it's not market. Market can fill you. I've had slippage on market orders that is crazy. Like I've hit a market order and it sold me probably down 20% from where the mark was. I don't use market orders ever. I stay away from them. I know Hassan says he does sometimes. I don't. I'm trying to get there before I'm trying to fill. If I'm selling something, I'm trying to sell it before I run into any issues, not like backpedaling, trying to catch it. Like, oh God, I got to get the fuck out of this position. Market sell. I mean, sometimes you have to, if you're in the wrong thing and there's, news that comes out and you need to eject yourself out of a position. Yeah. I try to avoid being in that spot to begin with. Here, can you send your questions to everybody just so everybody can see them? So somebody asked, is it usually a 15% stop loss with what I'm using? I like that number. It's good. Usually I can get enough if I enter at the wrong time, I can get enough pullback to hold. But I just like 15. It's all going to be determinant on the size of your portfolio and your own risk tolerance. For me, 15 I find to be a good number for everybody in the server. I'm not trying to have anybody take plays down to, I really don't like being down more than 15 or 20. So I don't really like to trim at 15% unless I see something that's telling me to do that. I would like to be at 30% to sell the entire position, right? So a 2-to-1 risk to reward. But I like the idea of when I get to 15% just to move my stop to break even. So I already had that. It's kind of like a trailing stop, but it's what it's doing is if I was only willing to let the play go down 15% at max, when I'm up 15%, I don't want to lose any money at that point, right? That's my 15% variance. I find that it's good as accounts and or reserve capital. Past that 15, I'm trying to take SPY plays that usually have a few days out. 15% does tend to move pretty slow, except on days like yesterday or today where I kind of got fucked like really fast, way faster than I had anticipated. But for the most part, it's usually pretty slow going. Where is it? One sec. Do I use, I pretty much only use the Fibonacci stuff to determine midpoints between moves. I don't really like, they're more of like a secondary thing for me. I don't really use them to base, like I'm not using extensions. I'm just using them to see, it's like, oh, if I'm ranging kind of to get a point. And of course this thing is not going to do it for me. Get a point like, oh, my midpoint's here. And then you can kind of see where the consolidation is. Usually it's good for that. I know there's strategies that rely on it. And I do sometimes see pullbacks on moves. Like you can see today, our 50% point was pretty much exactly where we closed. I think it's useful for that. It doesn't necessarily help you determine the direction you're going to be moving. I do like finding my equilibrium point. So today when we were there, it was almost exactly where we closed, right? We pretty much closed 50% between the high and the low, which also happened to be the close of yesterday. So it's good to see that. It's just another tool that you can use, a little bit more confirmation. Entries are mostly on the 15. If things are moving a little bit quicker, I'll go down to the 5. Just gives me a better viewpoint. But I like the 15. It's a little slower going. It stops me from making rash decisions. I went back to watching SPX on the 1 minute and it's just like mind numbing. It's too much shit moving back and forth. It's like a lot of the information. It's like you see a massive candle, it gets whipped back down. You see a massive candle, it gets whipped back down. I like to kind of, consolidate that data. And I find that the 5 and the 15 are pretty much my go-to. That being said, like if you're trying to determine trend, I would always recommend zooming out, look at the 30-minute, look at the 1 hour. Is there something that you're missing? But for entries, it's almost always the 5 and 15. Where is it? Do I set my stop with active trader? For me, I pretty much have all my stops as mental stops. I do something along the lines of this. So in my charts, you'll be able to see the 4100s that I took. I pull up my options contract. So I always sync a chart to the options contract that I'm looking at. And on the chart, I start to mark what my entry price was. And then I'll go down and I'll set an alert, oh, I'm down 10%, 20%, 15%, whatever it is. And then just set an alert that way. I've used IBKR like a handful of times. Not really. I don't like the layout. I'm like really fond of my Thinkorswim layout. I can execute well. I've never really had an issue with fills. I enjoy it. I like how it looks. It's not slow. Mobile app's decent. So I like the instant cash settlement thing doesn't really make a difference to me. For smaller accounts, I can kind of see the allure of it, but I think at the same time, it's like if you're trading with $1,000, and do you really need to have that settle instantly? Like, is that just kind of opening the door for you to make shitty trades, but like a lot of them very quickly? I kind of toy with that thought all the time. Like, dude, if you have $25,000 in your account, your cash is going to be usable all the time because you're going to be on margin, right? If you don't have that, like, I think that there's kind of a reason that you don't need instant cash settlement, right? Like, if you're able to make unlimited amount of trades, that means that you don't need to put as much thought into it. It's cool, but I feel like the majority of people that have that aren't ready for it, or they're just allowing themselves to burn through all their money, instantly, rather than kind of reevaluate, oh, I made this mistake wrong, I'm not going to do this again. They'll just like flip, take that trade, take the money, exit the position. Then they'll do that 5 times in a day and then realize they lost on every single position. I like Thinkorswim, the mobile app, more than IBKR's mobile app. Their mobile app is really hard to execute on. I would say avoid trading on your phone if you can at all costs. I hate it. It's doable. I've done it. I've made money doing it. I've lost money doing it. But would not be my first thing. I get like really frustrated when I can't move around a lot. Can't like set all these alerts quickly on the phone. It's going to take me 5 minutes to do something that here I can do in about 10 seconds. It's also hard to enter and exit a position. I was in a contract trying to exit on the phone, and it just kept dying, and I couldn't exit it because every time I went to submit the order, the bid and ask would keep dropping. So I was like trying to chase it down on the phone. That sucked. Little things like that. So, okay, back to the main point. So conceptually, does everybody understand what the basics are when we're looking at our price targets? Like, does it make sense that we're looking at, oh, we rejected here, or oh, we bounced here? That's the main spots that we're utilizing to kind of make our price targets. And does it make sense why that is? Okay. Now, okay, there's one person is here. That's good. So the second question is going to be, have any of you before today, do you ever make trade plans or strategies or go into the day and do something like what I showed you here, right? A little like how to strategize the possible outcomes. Has anybody ever done that before? But okay, but you're like, oh, my price level is red for puts, green for calls. But each price level can be either or, right? That's the trick of it all. If you're over it, you could take calls, but if you reject it, you could take puts. These price levels, like they're pretty unbiased, right? They don't care if you take calls or puts. The number itself doesn't matter. It's like how you react to it. But yeah, every price point could be a spot to take calls or to take puts, if that makes sense. Some fucking mental fuckery there. All price points are entry points for either side. Yeah, I mean, the supply and demand, the zone thing, it's the same thing, really. You're just looking at the lows, but all you're doing, and this is a good example, it's just giving you more of that range. So when I'm telling you that, oh, this price point, right, it has, some to the upside, some to the downside, you could be kind of considering, oh, if we might not come all the way up to it, but we could still reject, or we might wick over and we might still reject. That's really what this is, right? Some people even go further. And if you want to really get deep into it, they'll use the Fibonacci, and then like your halfway point is really your entry point in this. That's your real level. I mean, what you're doing there, and it's not always going to be, you're not always going to create a zone at the top, but just imagine, you know, a little to the upside, a little to the downside from all of these specific price points. This is actually just a regular price line on my options chart. Same way you say levels on the actual ticker chart. I do it here. It also helps me when I'm trying to remember my average endpoints, because I'm also watching the volume of the contracts. So seeing volume at my price point is always interesting. A couple little things there. Okay. Yeah. So that trade yesterday. Here, let's look at that. That was at 399. That was right here. All right. So why did I do that? So over the past few days, the 398 to 399.5-ish area had been pretty heavy for rejection. There had been a lot of points where we had either bounced from it, right? So when we were coming back up to test it, I didn't really wait on it, which was where I got burnt. And that's why I only had the 15%, and I wasn't holding it any longer. But I wasn't convinced with the way that we were moving, and especially when I entered on this candle, that we were going to easily rip through it. In hindsight, I probably should have just waited after having such a big impulse move. But it was literally because of all the consolidation that was happening in that area, and then seeing that 5-minute candle start to reject and almost form a doji. So I kind of took it there. Yeah, probably shouldn't have. I mean, that's the whole thing, though. It's like everything that I'm doing, I just didn't wait for the structure to form out. But a lot of the plays that I'm taking, I mean, even the calls from today, it's like there's a reason that I'm doing it. Like this, right, on this drop down where I saw that we had that heavy resistance, where we had the trend line from the daily come down. It's like this is technically fighting the trend. We entered here, right? We dipped down a little bit more, but we caught the move, right? It's just, I didn't wait for it to come back down. In this instance, it wouldn't have come back down to this level, right? It didn't really retest this spot on. So when I entered here, yeah, we dipped down a bit. Is that technically fighting the trend? Sure. Was there conviction on why I was entering that play? Definitely. Trust me, I had a lot of unhappy people with that put play from yesterday. And yeah, I'll own up to it when I'm wrong. Like I have no problem admitting it. I'm not fucking hitting 100% of the time, but a managed risk, like I knew that I wasn't going to let it go any further than 15%, right? That's a manageable loss. It was, you know, timing in retrospect, obviously, like, oh, why'd you take that? It's like at this point in time, we didn't have the other fucking 10 points, you know? It's easy for somebody to be like, oh, why did you take puts when we're already at the top? You know, potential swing high here. Like there was multiple things. I was just wrong. It happens. If you put your fibs on the low of the day, 2 Thursdays. Yeah. I mean, what I really should have looked at, and the only thing that really needed to be looked at was like this price level where we rejected the day before. We broke through it and held it. That was the candle that stopped me out of that put play anyway. Wick through. We were up like a bit and then boom, popped, held that level and then just carried on. Did its thing. anybody that can't talk about their losses, like there is somebody who is emailing me. They were really unhappy. They told me that they can make their own rookie mistakes. And I'm just like, oh, damn. Yeah, I could see that. But I mean, I signaled the play. I had a reason for it. I don't ever take anything just for like to lose people money. I say that all the time. It's like when I like obviously still make mistakes too, or I misread something, or I don't zoom out. Like I don't think anybody's perfect. I had reasons. My reasons were wrong. Take it on the chin, move on. Where is this? Okay. We're already getting a little late. I think tomorrow I'll cover how I'm actually selecting these contracts. So a little bit familiar with or knows what delta is. One person. Does one person know what delta is? All right. So when you're picking your contract, and we'll use this spot as an example. Let's say that in a perfect world, you always want to break through your level and then come back and retest that level before you enter. So in a perfect world, if we're looking to actually take calls here, what we want to do is we want to see it come up, come down, touch it again, and then go up, right? Because if you take it just off the break, you really have no confirmation that it's going to hold anymore. You can come right back down. That's how people, get faked out. So when that happens, I tend to use my options delta to determine what the distance is. Like if I was going to have another level of support somewhere, I take the delta and I measure out, we have, 0.4 to the next level that I'm going to use as a support if this doesn't hold here. And then I use that multiplied by the contract delta to determine what my loss percentage would be. And then that's kind of how I'm determining, if the distance between here and the next level of support is 12%, I'll be like, my stop is going to be 15, right? Because that means that not only is it not holding the main entry point, but it's not going to hold the level underneath it either. Just I'll break that down in more detail. That's a whole other class I'm starting to realize. Main takeaways from today: highs, lows, right? These are points, and these are really important when we have not come back to retest them or have been unable to break them, right? So you'll see that we have rejections of the same spot multiple times. Those are what you want to look out for. You don't necessarily need to zoom out to your daily time frame to have good levels. If you ever have somebody talking to you about a ticker, just pull up the 4 hour, do a quick little boom, boom, boom for the last week. Easy. Don't make it harder than it needs to be, right? What you're looking at, where did people stop buying? Where did people stop selling, right? We're in between those spots, mark them down. Plan out what you do if you get up and reject, up and break. Then the same thing with downside, down and reject, down and break. That's it. Figure out your contract pricing based off of what your next price target is, or the next low or the next high. Make sure that you're not taking something that's a million points out of the money, because you are literally just handing over your money to somebody at a hedge fund or a bank. What else? Anybody else have any other questions about any of this? You want to tell me that I'm doing it totally wrong? Literally anything. How do I choose my lottos? I can't give that away. No, it's the same thing. It's literally the same thing. It's the only thing about taking a lotto is that you have to take it on the absolute bounce, right? You can't have it break up in the down. You need to take it, and you need to take it before it starts to reverse. It's like you got to get real lucky with your timing. But then also, I don't like to take them until probably after 11. So I'm on the West Coast, where premium values have died down, because in order to really capitalize on it, you need to be able to move probably 30 to 40 points on SPX. And I don't want to buy something that's a lottery ticket when the contract price is $2, $3, $4, $5. So you're basically trying to find something where you're going to come down, you're going to bounce at a level, right, and go up or down. You can play it in opposite, and you need to catch it here, and you need to catch it near the end of the day. And like on a day like today, sometimes you don't get the movement, right? This move here would have been perfect if it happened over here, right? Happening over here, the contract value is too much money. If it happened over here, that would have been, several hundred points. Even when, several 100%, even when I added 4,100 call to the watch list, like it was something similar to that. I think that was around here. So I wanted to catch it at the bottom to ride it back up to the top. And when I looked at it here, the lowest that it got to was 0.85, and that got up to like 2.5 on this push up. But it's a lotto, because you don't know how high up it's going to move and how quickly it's going to make that move. And you need to catch it here. Like you have to catch it at the bottom, right? If you're doing it somewhere in between, you're just not going to capitalize. You need to get it. It's like absolute lowest. And that's why I have it written down. It's like, don't try and do that, over $1. If you can get 50 cents, which is what I was trying to get that 4,100 at here, that would have been fucking prime. But it only got down to 85, and then I just didn't signal it. Same concept. Everything is the same concept. If we're taking naked calls or naked puts, this is it. This is all you're really doing, right? This in a nutshell. This is options trading. Now, why you do this, are you looking at volume? There's obviously a little bit more that goes into it, but at a base level, looking for places that you've experienced volatility, right? So either it's bounced, it's held, whatever, and then play it to the next spot down or the next spot up. Yeah, I mean, the bottom is in a perfect world, you get somewhere like this, right? And then you come down on the same day, right? So then you're like, oh, good, hit here, comes back up, hits here, rolls up a little bit, comes down, hits it again, doesn't break, then you can buy it right there, and then it goes up. It's a lotto for a reason, right? There's like, sometimes you just gotta feel it. But you don't need lottos to make money. I mean, 410 call, I think it was 410 call, or is it 4,100? Somewhere over here, 410 call, I think was 5 cents, or was it 4,100 was 5 cents over here, right? That's like unreal. That's what I'm gonna do next time Powell speaks. I'm just gonna buy calls and puts fucking 130 points out of the money on both sides. It's gonna be my day. Why do we take out of the money contracts versus, I've been playing at the money, or even I think we had a couple plays earlier in the week that were in the money already. They're less volatile. I know that a lot of people that play SPX on Hassan's contracts, especially people that are newer to the options market, they might not be ready for something that moves super fast. So I try and pick contracts that will make money, but also move at a slow enough pace that newer people can execute on them. That's really the big thing for me. It's like, I could just trade SPX all day. It's like, I like SPY, it's a little slower, whatever, but I would normally just trade SPX just for how much more money I can make from it. But it's not really about me at a certain point. It's like, I could do that, but I would like to see a lot of the newer people that come in, manage your risk. That's why I also am trying to keep it, as small, minimize losses to the best of my ability. Because, you go in, remember when you're trying to take an options contract for the first time, the reality of the situation is there are a lot of people that have never really traded options before. And somebody's got to kind of cater to those people that are really learning. You have to be aware that there are people that are going to come into the server. It's like not everybody has experience. So I try to provide plays that aren't going to absolutely blast them, because I know that my first day I was like, oh, 0DT Tesla. And I got, for lack of a better word, the shit kicked out of me. So I'm trying to avoid that for people. Slower plays, that's about it. I mean, if you're taking something that's in the money, I'll tend to take it. If I see a bounce here, my in the money play will be at the level or below. So then at least I have something to kind of hold it up, keep intrinsic value. No other questions? If that's it, I'm going to go eat some food. I haven't eaten all day. I will be around tomorrow. If you have anything else, just hit me in the server. I do kind of want to cover in a bit more detail my contract selection. I didn't realize that we were going to take so long to just kind of describe this in theory. But the contract selection process, because I know some people don't really understand how to pick their own contracts. They kind of get the idea of the support and resistance, but when you're like, hey, pick your own play, they're totally fucking lost. Their eyes like glaze over. I've been there. So I do want to break down how I'm doing that with a little bit more detail. Tomorrow is what? Today's Thursday. Tomorrow's Friday. Tomorrow, hopefully, we're not just ranging like this massive wedge. And we can cover the plays from tomorrow specifically. I can explain why I took whatever contract when we take it. Give a little bit more real life breakdown on something that's going to be fresh in everybody's head. So that will be tomorrow. Thank you everybody for popping in. And again, if you have any other questions, just at me. Oh, did I not upload the last one? Shit. Yeah, I'll do that. All right, guys. Catch you tomorrow.